Good morning, folks, and welcome back to Almus Market Mornings. While the US and Iran mutually bomb each other for the fifth straight day, the focus was on markets dialing back the rate hike expectations after a softer PPI. In the last 2 days, the data on consumer prices and producer prices have been softer, giving some level of confidence that the Fed might not need to hike rates with the same degree of aggression which markets were earlier pricing. This, of course, has resulted in yields falling. In the last 2 days alone, the US 10-year yield has been down about 10 basis points. 2 year is down about 15 basis points, and the dollar index has seen a cool off as well. Good morning, JK. Where are we on the rate cut expectations? How many rate cuts are markets currently pricing in?
Right.
Rate
Good morning.
hikes. My bad. It's rate hikes, not
Yeah,
rate cuts. Yeah.
okay. Yeah, in fact, today already we had one rate hike by Korea, you know. So we are still in that, rate hike scenario, not in rate cut scenario. And conditions are not really changing, notwithstanding the two reports on two consecutive days where, US inflation was shown, much lower than expected. In fact, these two reports have, coming one after another on much lower than expectation, has taken some attention away from what's going on in the Middle East. So we have seen, a bit of cooling off in the sentiment as well. But despite even PPI inflation coming, at multi-month steeper drop, and below expectations on most of the accounts. It's not. I mean, let's. I mean, we should not take it as very bullish for the markets or the rates, because one thing, as many Fed members have also stated, that 1 month report is not enough, and we should have we should see whether it is one of factors or it's a trend that is developing. Secondly, the Middle East conflict is ongoing. We don't know when it will further escalate, and if oil goes above 100, you know, these all these things will be immediately forgotten by the market. Then, as one of the members also said, the inflation is also driven by other factors like AI-related huge spending, which is leading to broader-based inflation also. So there's little to be too complacent about these things. If you look at member statements, Mr. Waller couple of days back had said that we may even have to act much earlier than what the market expects. Although yesterday one or two members were happy with the way inflation had behaved, but I for one would be very cautious, because it's just 1 month's report, and it's just, see, even if it has dropped from very high levels, and it's not as though we have been nearing the inflation target of the Fed. So market reacts with a lot of knee-jerk, sentiment. That's why yields came down. Dollar index also came down, but yields are not. Yields are still holding above good supports. They're not crashing. So slowly they tend to rise as well. And if the inflation was seen to be very supportive of rate hikes not happening, you wouldn't have seen Japanese market and Korean market just slide today. Korea is down 7%, Japan down 3%. Of course, they had also risen yesterday, but it's not that we are seeing a continuous rally in the markets. US markets were positive in the stocks only because of good earnings from the financial sector. So I'm taking these with a kind of skepticism. Reactions are knee-jerk and not likely to sustain. Dollar has come off index, but still holding around the key level of 100.50. So enough reason to be cautious. In fact, there is also some indications that the IRGC has threatened to close other export corridors that benefit US and its allies. So they're particularly talking about another route, the Bab el Mandeb gateway to the Red Sea, uh, which they are asking the Houthi allies to, stop passage of ships and all that. So, such being the case, I don't think we can remain complacent on either the geopolitics or on the oil prices. Therefore, the inflation is just a short-term uh, kind of relief or maybe profit taking on the short position in bonds or the long position in the dollar, but it doesn't change the position. If you look at the commodities, for example, gold and silver, they again continuous. They had only a knee-jerk up move, but then gave up all the gains, and they're again trading with a bearish bias. So, not taking this with any major bullish view. Some significant statement from Wars also. Is not happy with the measures of inflation which is being used as of now. He will also start getting briefings from the task force as early as September. But actually, this is an indication to me that you will not have a rate hike before October, because then he probably is relying a lot on the study that these task forces are making, and he would be basing his decisions on these. So to answer your question, eventually the rate hikes, I think they are not out of the contention, very much there. Whether one or two is something that will be decided probably by the next two PCE inflation reports, which the Fed values a lot. And September, whatever conclusions that Wars makes out of the task force reports also will be something that we'll look at. So till September, you can hope that the rates are not going to be hiked, but markets still can have the yields move depending upon how the oil prices are going and other measures of inflation are going. So some definitely cautious welcome to these numbers. And on the currency front, euro has made some progress to the upside, breaking 1.1450, which was stopping it, but nothing significant. It is GBP which is been the strongest among all the currencies. It's broken good resistance above 1.35, and some of the big short positions on the GBP, which were taken in the wake of the political stalemate in UK, they have been unwound. And also the new finance minister, incoming finance minister, about whom the speculation is there, is said to be market friendly, particularly good for the bond market, is what they are expecting. So it's again a story that's built around a bullish GBP, but definitely it has outperformed. Yen does not see any strength below even 162 sustaining, so it's trading above 162. So no major reaction from the dollar, except some skewed reactions from some currencies is all that we can see. For the rupee, we are definitely seeing some resistance at 96.40, which I think even technically there is some resistance. It's like the last 1 month or so, we had seen initially strong resistance at 94.70, that gave way, and then 95.50 was holding for a couple of weeks, and that gave way. Now 96.40. So as it breaks the resistances over a period, the market sentiment also remains quite cautious, and that is what we are seeing. Yesterday, in fact, the day started with good selling by foreign banks related to some inflows. However, all of that got absorbed, and we were again testing the new cycle lows at 96.30 and above. So it remains cautious. See, there was also a report about bankers being in negotiations with the UAE central bank about the regulations on FCNR, etc. And some new estimates show that FCNR funds before September can still be a good number, but market remains cautious. And on the other side, there is also a report, which says that US senators have introduced a revised Russia sanctions bill proposing 100% tariff on goods from 5 largest buyers of Russian crude and gas, including India. So India's imports of Russian crude rose to a record 2.58 million barrels a day in June because of supplies being constrained from Middle East. And also discounts offered by Moscow. So it's a repeat of what we had seen the last year. Now US is also proposing these new tariffs of 100%. Again, we are back to the same situation after all the negotiations and the trade deal talks that are going on, etc. Of course, this may be it's not become a law. It's just a move by some senators. It may not go through as well, but the challenges remain. Something or the other as we go come through one challenge, a new challenge appears. So that's why the rupee continues to be on the defensive side. So yes, 9640 is holding for now, and maybe yeah, on any major negative trigger, rule of sorry test of 97 is also not ruled out, because the flow pattern from the importers and exporters is not still changing. Importers are still dominant. So that's what it is. Let's see. I think it's a time when we have to look for some new triggers every day, particularly when geopolitics is in play. We have to be really cautious. Thank you.
Thank you, Jackie. And yes, the early celebrations with respect to inflation coming down may be spoiled if geopolitics really flares up, because we don't know if the inflation that has come down in June, whether it's one-off factor or something that is sustainable. And if, let's say, the war escalates, then you have another scenario in which energy prices could be much higher from the present levels. So even if you look at the yields, even though they have fallen in the last 2 days, they haven't crashed. They are still holding above key levels. And JK made an interesting point. If the rate hikes were all priced out, then Japan and Korean equities would not have slid down significantly as seen today morning. So there is some tapering of rate hike expectations, but it is to be taken with caution. On the currency front, dollar index was broadly down. USD INR rupee still trades on the weaker end above 96. Somewhere USD INR is seeing resistance around 96.40. Uh, there are a couple of things which are clouding rupee's outlook. One is, of course, the FCNRB related flows not picking up significantly yet. And secondly, the US Senate bringing a legislation which would put tariff on the Russian oil buyers. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.